Hello, everyone, and welcome back to our series, Fundamentals and Practical Leadership for New and Emerging Leaders. Today's session is focused on financial accountability. We're going to focus on two quotes. Show me your finance, and I'll tell you what your mission is. And money is one of your resources. And just like the resources of time and skills, if you don't understand what you have and pay attention to how you're using it, you cannot maximize how it supports you in meeting your organizational mission. Our hope for this session is to provide an overview of how to read financial statements, how to budget, and other basics about finances, like a Finances 101 for leaders. So as new leaders and managers, you might have been previously exposed to organizational budgets, or you may not have. At this time in your career, you might be responsible for some budgets, or you may not. But it's really important for you to understand how finances work, what your responsibility is in them. And when you get to a time when you are asked to put a budget together, that you have a really good framework on how to do that. So today we're going to talk about financial terms and language. We're going to review organizational financial statements. We'll provide a template for how you can develop some budgets. And then we'll talk about some tips and tricks as we go forward. So why money? One of the things that I think is really important for us to remember, regardless of where you are at with respect to your leadership journey, is that a key thing about leadership is that we need to be really good stewards. And leaders are called to be stewards with respect to time, with respect to finances, with respect to skills and experience that people bring to the table. And often what we find, particularly in not-for-profit organizations, is that people are a little bit nervous about learning about money and how to use it. And often we don't pay enough attention to it. That, or we pay too much attention to it. So today what we want to talk about is the fact that as a leader, this is one of your main responsibilities, to understand and steward the dollars that you are responsible for. Particularly in not-for-profit circles, that becomes important because either it's donor dollars, it's taxpayer dollars, or it's even in-kind donations that are provided to you, that you really need to understand how it all works together. So that's why we want to talk about money today. So just so that we get started, let's talk about financial lingo and see how versed you are related to different financial definitions that are out there. So what I'm going to ask you to do, as we do every time, is if you could go into your chat, and I'll start just by asking you if you could put your name in your chat to record who is here. So just open your chat. Thank you. Morning, everyone. See lots of you coming on. Thank you. I know it's been a really hard month with the pandemic, so I'm grateful for all of you being here. We hope that this might recharge you and give you some good tools. And we also want to say thank you. Thank you for all the work that you do on behalf of the people that you serve. We know it's been a really tough stretch as we speak to leaders, but we're grateful for you. So on the chat, as we do every time, there is a link. It's up now. I'm going to go there now. And what we want to hear are what you know different definitions are. So here is the first one. And so what is the definition of an income statement? So like the other, so you go to the poll, you write your definition. If you like another one that one of your colleagues shared, you can like that one. So what is the definition of an income statement? The money coming in. Earnings. How much money is coming in? Close. Money's coming in for a program. Kind of sounds like it should be income. Any others? A statement of all incoming money. Money earned, what you're bringing into the program. Earns and spending. Yeah. Money coming in versus expenditures. All proposed and incoming funding. In and out money. In and out money, that's close. Profit and loss. Okay, we're going to work and kind of provide you some clear definitions of these, but it's just interesting to see where we're at. So what's an income statement? And you'll hear this often if you sit at board of directors tables, you'll learn about different income statements. One of the things that I'll say to you is, as you're growing your leadership skills, a really good place to learn about finances is to sit on a board, and then to learn about how finances are used at a board table. So encourage you to think about that. Whether you're sitting on one now, that might be a really good goal to think about, where you might sit on a board to learn more about finances. So, all right. So one definition there: revenue and expenses. Absolutely. Yeah. Cash balances. Yeah. All right, so it does have to do with revenue and expenses, your income statement, although I understand the word income is kind of a funky one there. All right, so the next definition that we'd like you to think about is, what is the definition of a balance sheet? And hey, you can provide something that you think is, if you don't know, it's like, what do you think it might be? It's a balance sheet. Stumped you a little more, huh? Seeing it there? I'm not seeing responses yet. Definition of a balance sheet. Shows money coming in and going out. Money's in and money's out to create a balance sheet where money in and spends are compared. Trucking of money in and out. Deposit and withdrawals. Yeah, there we go. Assets, liabilities, and owner's equity. Yeah, that's closer. Absolutely. Absolutely. So Carrie will talk a little bit about these definitions, but very important for, and in the slides, you'll see there's a bit of a cheat sheet, helpful for you to get some of these terms down. What's an income statement, for you to be able to picture what an income statement is? What's a balance sheet? What's the difference between the two? And how are they used as we think about finances? So as a leader, helpful just to get some of these key definitions down and understand, have a bit of confidence as you read one of these. And a balance sheet can actually be quite intimidating because it kind of all balances at the end, and you're not 100% sure what that actually means. How much money do you have in certain places? So we're going to go through that again today for you to have an understanding. A balance sheet is a really important tool for an organization to understand its overall picture in terms of finances. That includes assets as well as deficits and debt. So there it is. What is the definition of debit? This is where you kind of think, why didn't we learn more financial literacy when I went to school? And I think that's beginning to change. But definition of debit, without looking on the internet if you can, but hey, if you need to, you need to. A transaction. Yeah, it is a transaction. Money going out. Money out. Yeah. Yeah. Terms used to pay money out. Transaction of the payments of goods and services. Yeah, money going out. Sounds like it. Debit sounds like debt. Money not in hand. Yeah. Okay. Money going out. So now, left side of the balance sheet. Very good. Transactions of the payment of goods and services. Yeah. Some of you who are financial, have a financial background are going to love this, because you're going to get all the right answers here. Yes. Money going out, money owed. Let's go to the next one. Therefore, what's the definition of credit? And then why you might be thinking, why do we have to complicate these terms? Money owed. Money available. Money coming in or available. Money in and available. Transactions of money coming into the bank balance, right? Money available. An increase to a revenue or a decrease to a revenue. Credit equals money owed. Money owed and also money available. All right. There might be a few more just to get us going. What is the definition of depreciation? Something that's losing value, value decreasing. Very good. Yeah. Value decreasing. Loss of asset value, when the value decreases over time. Very good. A calculation to reduce the value of a capital asset. The net value of a particular good or product decreasing over age. Very good. I like that. Leaving a car dealership, car losing value after purchase is is a very good example. The second you drive it out is a very good example. Loss of asset over value, absolutely. And I'll ask you just to use the link there to get your ideas in. My life, oh, lower value. Okay, so if that's depreciation, what is amortization? Stump. I always have to think about this, depreciation and amortization. What's the difference? Spreading cost over time. Value spread over and an amount of time, yeah. Similar to depreciation for non-capital assets, or is it the other way around, I wonder? Yeah, period of time that cost is spread out to, yeah, spreading cost over time, that's right. The period of time in which the good or product is valued over a set period of time. Yeah. So again, helpful for us as leaders to just have a working knowledge of some of this information. So very good. Okay, and so in financial terms, there's also a few important ratios that people talk about all the time, and lots of us go, as though we understood. But again, helpful as leaders just to understand, what is the definition of ROI? Yeah, return on investment. So if you can go a little, y'all got it. Perfect. So what does it mean? What does ROI mean? Not sure. Yeah, good. We're going to actually talk a little bit about that today. It's return on investment. So what does return on investment mean? How well investments do. Yeah, in exchange for your investment, you get something of value. Yes, what did you receive on your investment in return? Value gained from investment. Might you get back from the investment? For every dollar spent, the value that it brings into the organization. Yeah, so helpful for us to know. For example, if you're thinking about running a program, two different kinds of programs, and they're, maybe best practices could go either way. One of the things that you might want to do is say, okay, what's our return on investment here? What might be, if you do some calculations, we'll talk about that today. Is there a way of me knowing which of these two options is actually a better return on investment for what we put into the program? So it's used often. And it's actually a really important ratio. We'll talk about it today. And of course, we also hear about social return on investment, which is like a double bottom line. We won't get into that today, but it's something else for us to think about, that there's financial return on investment, and we can also talk about social return on investment for another webinar. What is the definition of quick ratio? That's another really helpful financial ratio for us to know. Lots of us know ROI. What is quick ratio? Yeah, not sure. Makes sense. Well, when would I use this? How does this, how do we figure this out? It's actually another really important tool for us to have an understanding, a measurement of the cash available. Exactly. It helps us to understand how much liquidity we have. So again, Carrie will talk a little bit about that, and then we'll talk about how we measure that. And again, you might think, oh, I'm not even in charge of money. Why do I need to know this? But again, what this is about, the fundamentals of practical leadership, of leadership are about, is being able to be well versed, to be able to sit at a table of leaders, sit at a table of board, and understand what it is that all of this terminology means. Yeah, a measurement of cash available. And I think that's it for these. Let me just check. Yeah, so I'm going to get out of this, and I'll ask you to come back to Zoom. So you should be seeing my my screen with it says financial lingo on it. So hopefully look for the Zoom icon if you're not able to get there, or let us know by the chat. And so with that, I'm going to turn it over to Carrie to talk a little bit about the actual definitions.
Thanks very much, Maria, and thanks everyone for participating in that. exercise. And yeah, some of the definitions, we have people who came bang on, and otherwise we had people who came very close. And as we went through it, certainly as you get down to something like quick ratio, it's not something that you might have come across as much as some of these other some of this other lingo. The interesting and unfortunate thing about financial lingo as well is that sometimes people will use different terms. So we use the term income statement, was the very first one that we asked you about, and absolutely it makes sense that you looked at that and said, okay, it's a listing of revenue, it's our income. It is, as some of you noted, actually your revenue and expenses. And another word that you may find that's actually a bit easier to say, okay, yes, I would understand what this means, is a statement of operations. So sometimes you'll see it called an income statement, sometimes you'll see it called a statement of operations. But again, it looks at a time period. Most organizations will look at their income statement monthly. But if you sit on a board of directors, for example, or if it's something that comes to a leadership table to look at, it may be quarterly that you look at it. It's fairly rare to look at it only annually, but that's also a possibility. And it allows you to compare yourself to your budget. So what did we think our income and expenses were going to be, and what have they been to this point in time? Potentially course correct if necessary, if expenses in a category are way above where you anticipated them to be, or also if they're way below and there's a reason that they're below, and you know what, they're going to stay low. Well, maybe we need to reallocate that money to something else. You can also compare yourself to previous years. And of course, something that COVID has caused, and the pandemic has caused for a lot of organizations, is it's difficult to compare to a previous year because things have changed so much from what we budgeted or what we did pre-COVID to what they are now. But that is your income statement or your statement of operations. Balance sheet, number of people got that. It is a listing of all of your assets, which are the things that you own, the financial value of the things that you own, and your liabilities, which is the financial value of what you owe. And we'll look at that a little bit more detail, but those two items must equal each other. So that's always something interesting, as Maria said, a little bit more challenging sometimes to get your head around, but we'll look at that in a bit more detail. Debit and credit are two words that we use a lot in our sort of daily life with our debit cards and our credit cards, but from a financial and accounting perspective, and a number of you had this, a debit is when you subtract something from an account, and a credit is when you add something to an account. And it depends on whether you're in revenue or expenses as to exactly what that means to your total bottom line. So debiting, subtracting from your revenue versus subtracting from your expenses, two different things. Depreciation and amortization are kind of interesting from the perspective of, if you look at definitions online, again, this is something where some organizations use it slightly differently. So the definitions online talk about depreciation being intangible assets. For example, your website development. In reality, we use depreciation fairly similarly, whether it's a tangible or an intangible asset. And amortization, if you've ever had a mortgage and you think about your mortgage, and again, many of you have had this right, what's the total value of time? So you amortize a mortgage over a certain amount of time. It's the same with an asset. So you buy a piece of specialized equipment, and the likelihood is you'll have to replace it after 10 years. Well, you're going to amortize the value of that over the 10 years. And the depreciation is how you bring the value of that down year over year so that you hit zero at the end of 10 years. So what accountants, what the government of Canada doesn't want people doing is, as they approach the end of the year, particularly businesses, not-for-profits a little bit differently, buying a bunch of really big things and just putting the entire value into that year for sort of financial tax reasons, when really that thing is going to actually take the organization through a number of years. So it's the way of more accurately showing how much a piece of equipment or a building, or what have you, or your website development, how long it lasts you for and how long you use it for. Return on investment, I think many of you had it right. How profitable is your investment? For what you spend, how much are you getting in return? As Maria mentioned, there's the idea of the double bottom line, that it's not just a financial return that you're looking for, but it's also a social return. So it may be that you're actually spelling out profit from an outcomes perspective, and it can be used as a way to compare alternatives. If you're looking at a number of different ways of doing something, what's our return? And the quick ratio, we'll have a look at that. That's something, again, that you look at in your balance statement. It is how much of your short-term debt or liabilities could be covered with cash that you can get your hands on quickly. And it tells you a little bit about the stability of an organization. And again, we'll look at that with some numbers to give you a bit clearer picture of that. So really well done. The work that you did in answering our polls, and I think you've got a relatively good handle as a starting point on some of this lingo, which is great, because what the last thing you want to do is be sitting in a meeting and hear lingo and not understand what's happening. So we'll move on to our next slide, please. And we're going to do some basics about financial statements. So we'll keep going into the next slide. Really, really basic financial statements. So I've just created a couple of here to, again, walk you through what these different things are. So on the left-hand side with the pink title, income statement. Again, that's sometimes called a statement of operations, but that's exactly what we talked about. You have your revenues, what you received, and let's say this is for the month of January, it's just wrapped up, and you're looking at what you received in the month of January and what you spent, your expenses in the month of January. You spent $5,000 less than you received, and therefore you have $5,000 net income, which is where that income statement comes from. It's really that bottom line that you're looking at is your net income. How much did we spend compared to how much we received? If you look on the right-hand side to the balance sheet with the green heading, you can see the arrow takes that net income down into a line called retained earnings. So that net income, if you end up with a positive, it moves over into your balance sheet. And you can see that it's moved into the balance sheet as a liability, essentially because you owe that money to somebody. You have $5,000. It may be owed back to the Ministry of Health or some other ministry if they require you to return unspent funds at the end of the year. So it ends up in the liabilities. Let's go to the top though and look at that, your assets as a chunk. So essentially your assets are what you own. Where do you have your money sitting that you currently have? You have 10,000 in cash, you have 30,000 in investments, you have 5,000 in accounts receivable, so invoices that you've sent out that haven't been paid yet, money owed to you. That's considered an asset because you will receive that money. It's just that it hasn't happened yet. And your capital assets, which again might be a building, might be a ton of equipment or furniture, computers. Those are all the things that you own, which is very similar if you think about it, if you've done a net worth statement as an individual or a family, sort of listing all of those assets, things that you own. And then the bottom half are your liabilities. What do you owe? And what can be a little bit tricky about this is it includes what you owe to yourself, because your assets and your liabilities must balance. That shows financial people that you know where your money is, you know what you have, and you know what your money that needs to go out to somebody is. So accounts payable, these are invoices you've received in that you haven't paid out yet. So they're sort of short-term liabilities, much like accounts receivable. You retained earnings, either you owe it to some external organization, or it's $5,000 that you get to keep and spend on something else. So it's owed to you to spend. You can see that you have $100,000 invested in capital assets, and you have $100,000 in capital assets. That's where, again, you'll see amortization and depreciation coming into play. If those $100,000 in capital assets have been amortized over 10 years, you'll see both of those lines dropped by $10,000 each year as the depreciation comes in. And then unrestricted funds may be funds that you have sitting in a bank account, again, that's there for you to spend on something. So it's not, unlike a for-profit organization, that's not money that the shareholders are going to take out. That's not money that's that's going to leave the organization in any other way other than you as the organization spending it on your mission. And I think, Maria, if you click, we might see another little image on this slide. I'm not sure. There it is. So that's just gives you a bit of definition again on your retained earnings. You may be allowed to keep it and perhaps invest it or spend it on either invest it financially or invest it into a program or service, or it may be required to be returned to a funder. So we'll move on. So income statements, again, just to give you a few brief notes to think about. You're looking at revenue minus expenses and resulting in a net profit or net loss, or retained earnings instead of profit is what we call them in the nonprofit. It's a comparison of periods of time, or it can be. So you could look at what happened January this year versus January last year, or you could look at entire years or other periods. It gives you an opportunity to compare what you're doing against your budget. So what you expected to be doing in a month versus what you actually did. And it's based on your activity from a revenue perspective, if you're doing fund development, or if it's coming from a ministry or some other funder, as well as your activity in your programs and services. So again, you can see how the pandemic really will have made it difficult to do those comparisons over time and comparisons to budget, because we had to make so many quick decisions and quick changes. And there are financial statements versus management statements. And that's an important thing to think about. Income statements, or if you call them a statement of operations, is much more a management statement. When you do it monthly, when you do it quarterly, it allows you to see what's happening and potentially make adjustments that you need to make to your fundraising, to your program service operations. A financial income statement is one of those things that comes in your audit package at the end of the year and really looks at your full year, compares one year over another, and gives you more of a financial view as opposed to something you're making decisions on, which you should be doing, looking at your statement of operations monthly. And we'll move to the next slide. Thank you. So our balance sheet, again, this is another example of what a very simple balance sheet would look like. It would be rare to see something this simple in an organization, but again, it's just to help you acclimatize a little bit to seeing these kinds of things. And this is where we go back to the quick ratio. Again, there are many, many ratios that one can look at in an organization, and your financial folks look at many more than this. But one that is important, one that's interesting, I think, on a regular basis, is your quick ratio. Also has another name, acid test ratio. And it looks at what is your easily accessed cash and what is your liabilities that you may have to pay very quickly. So in this balance sheet, your cash obviously could be easily accessed. It is cash, it's probably sitting in a bank account. Your short-term investments are generally somewhere that you could quickly get them out if you needed them. Your accounts receivable, it depends. If the money's gonna come in, people are gonna be paying them, that's great, but you can't 100% guarantee that you can get your hands on it immediately. And obviously capital assets, this isn't about selling equipment or that kind of thing. This is about how much cash could we get our hands on by next Monday. And in this case, in this balance sheet, it's $40,000. So your quick and easy access to cash and your current debts. So again, if we look, you have accounts payable of $20,000. You have invoices sitting in front of you that you need to pay that are worth $20,000. And we're going to use the owed to the ministry as well. We're going to assume you're an organization where the Ministry of Health takes back funding and they've asked for it. So you need to, you may need to get that, or they may ask for it in very short order. So theoretically, you have $25,000 worth of debt in there that you might need to pay in a hurry. So you look at those two against each other. If we're in a hurry, to pay our $25,000 worth of debt, we could actually access $40,000 worth of cash very quickly, which means that your quick ratio is 1.6, which means that for every dollar you owe to someone else, you have $1.60 in available cash to pay it off. So that's a very healthy quick ratio. To know that you could pay your debts very quickly if you needed to, if those debts were called on a very short timeline. So again, we'll move on to our next slide. Audited financial statements, again, so these are less things that one uses for managing day-to-day decisions, like your income statement or statement of operations. Something that really you're going to get annually, and something that a board of directors is going to look at. And I do agree with Maria, being on a board of directors is a great place to learn more about how finances work. So they tend to be fairly lengthy documents. This is just like a couple of quick tips. If you're looking at audited financial statements, what do you want to look for? So the first thing you'll want to look for is the audit opinion. And what you're looking for is for the auditor to say that the evidence they received is sufficient and appropriate, and that the financial statements present fairly in all material respects the financial position of the organization. And in many cases, that's the exact language you'll see. If you have a good audit, if you have what some people call a clean audit, if you don't, that statement is going to be modified a little bit. To say the evidence wasn't sufficient and appropriate, to say that it does not present fairly, that there's exceptions. And in that case, what you get, next line down, is a qualified opinion. So they say it presents fairly in all material respects the financial position of the organization with the following exceptions. And those exceptions mean, okay, there may be something going on here that we need to be aware of as far as how the financial statements work in this organization. And they call it a qualified opinion. Now, important to note that if an organization has fundraising activity, it will always have one exception, and that is related to fundraising, because auditors will say, you know, the way that donations come in and are tracked, it's impossible to do to 100% assure you that every single donation was looked after properly. You know, if you have volunteers fundraising, if you have cash coming in, it can be impossible. So that will be an exception in pretty much every organization that has fundraising, and that's never something to worry about. If there are other exceptions, that's what you want to look at. There's going to be common language in all of the financial statements saying what management's responsibility was and what the auditor's responsibility was in creation of those. And then you're going to get financial statements that year-end financial statements. Usually they also compare to the previous year, and some notes that provide some further explanation to those. So we'll move on to our next slide, where we're just going to have a very quick look and do a quick poll. This is a more real life financial statement. It's actually the Southwest Local Health Integration Network Statement of Operations for the year ended March 31, 2020. You can get this off their website very easily. And again, you can see the revenue and expenses are really rolled up here. So it's a fairly short statement. In some cases, you'll see statements where the expenses are broken out much more significantly. And you can see here that, you know, it's $2.5 billion in total revenue, and it's $2.5 billion with a B in total expenses, and where those expenses have gone. And then you can see their excess of expenses over revenue. So they ended up in a negative position. They spent $90,000 more than they had. So we're going to take you to a quick poll before we end off this section, and just ask you to put a dot on the screen. If you go to, again, the link in the chat, it'll take you to this, that you can see this slide there, and there people are starting to do it. You know, where are the places that you'd want to ask questions about in this statement? So we've got a question about how in-home clinic services. So perhaps what we're seeing the question there is, that in 2020, we spent less on in-home and clinic services than we did in 2019. And that's about $6 million less. So why might that be? Salaries and benefits, I think there might be dots on there. Those have stayed very, very stable from one year to the next. So again, is there a reason for that? Other revenue, I see some dots on how it's increased, but other revenue is often something, even though it's a relatively small amount of the budget, it's always sort of interesting to see, like, what is that? What is other revenue? And often it's an amalgamation of a number of different smaller types of revenue. But that's potentially a reason for a question. The notes, we've got people, we've got someone who's put a dot on the notes, and absolutely that's a good place to ask a question. So yeah, you have the opportunity to compare from one year to the next. Have things gone up and have things gone down? And if so, why? It says the accompanying notes are an integral part of financial statements, and someone has a dot there. So yeah, you'll see that where there is a number under notes, that you will be able to, we're not doing this today, but you will be able to go to another page of the financial statement, find that number and see what the auditor has to tell you about it. So they will have explained it a little bit more. And, you know, in the case of the Southwest Local Health Integration Network, they are coming in with an excess of expenses. And the question for me related to that would be, you know, well, where is that money going to come from? Now, that being said, they come pretty darn, you know, $89,000, you know, off budget for a $2.2 billion budget is pretty impressive. Frankly, that's a really close result there. So hopefully that gives you a little bit of a sense that even though the numbers are bigger, much bigger than the examples, it can still be something fairly simple to look at, and you can find places to ask questions. So I will hand our presentation back to Maria. Thank you.
Great, thanks so much, Carrie. So that is a high-level overview of finances, particularly when it comes to audited financial statements. And you'll see that part of the reflection exercise for this section is for you to actually review some audited financial statements, but we'll get to that when we get to the information related to the reflection for this session. What we want to turn our attention to, so this is what Carrie presented is like an overview, in general overview of finances. And you might also then be interested in, okay, but what do I do in terms of budgeting? What are some of the basics from a project budgeting perspective? So again, this might be where you have a really great idea for perhaps a summer program or something new, and you are maybe putting a grant together and they've asked you to put a budget together related to that. What might that look like? How do I go about doing that? So one of the things that you will be receiving in the package for this webinar, in the portal that we have, is an Excel spreadsheet that might help you with that. So all I want to do right now is just go through that a little bit to give you an idea of how that works. So really, I think I maybe have some slides here, important things here. The one thing for us to think about in terms of project budgeting is, the first one is, what financial assumptions are you making? And sometimes we move into putting numbers in our budgeting without really thinking about the financial assumptions. But a really good budget always has financial assumptions. And so even if you're presented something and you're looking at the numbers, you don't see any assumptions, you might just ask about that. Like, what kind of assumptions did you make when you created this? So all of them have assumptions, and they are really helpful to articulate so that you can confirm and test and change your budget according to your assumptions. And often you go back and forth in terms of the assumptions you started with, and then you saw the numbers and you think, I got to change that, and so on and so forth. So articulating assumptions in a good presentation of budgeting has that right at the beginning. And then you really want to look at your overall financial expectations, your revenue, but really starting to think about what's my fixed expenses, my variable expenses. And in the not-for-profit world, we talk also about in-kind contributions. So, you know, at the end, you think, well, we had so many different volunteers, or these organizations provided these parts, and we often don't capture that. And that's actually a really important point to capture because it helps you understand the full expense of a program, and then the donations that were provided. So you can really speak to that aspect of it as well. So in the form that you'll be receiving, the budgeting form, you'll note that all of those components are included, and we hope that it might help you and guide you as you develop some budgets. So the first tab you'll see is an assumptions tab. And again, here you'll see that it's like, okay, what's the date, name of the project, and then your financial assumptions. So your overall financial expectations. So do you have a certain return on investment that you need to hit? Are you hoping that the program will break even? What is the expected revenue that you're looking at? Those are all the things that you might include here. Also, your revenue sources, like you're thinking, I want to run this. Is it going to be all related to participant fee? Do you have a grant for it? Is there funding from your programming? Do you have a specific donor that's really interested? What are your revenue sources? Your fixed expenses are those things that don't change, and it's not related at all to the number of people that come. So the difference in fixed and variable is fixed might be the cost to rent a facility, same, no matter how big or small the group is. Variable are the things that do change. So that's, for example, meals are going to change based on the number of people that participate. And then finally, your in-kind contributions. Like someone might say, well, you know what, I'll provide the supplies for this day. I'll provide the meals, whatever it is, you want to account for that as well. So your project budget, here is an example of what it looks like. So, and I'm going to run through, highlight a few things. So you'll see here that we have, actually, I'll do it just because of our time. I'll do it right through the example here. So in the form that you have a template and then you have an example so that you can kind of go back and forth to see how it works. So you'll see here that we have the actual cost, revenue or expenses, any in-kind contributions. You have some notes so that you're able to figure it out. We also put a per person cost so that you're able to articulate that. And then right at the top, you can articulate how many participants you imagine coming to the program, if that's what you're counting on. So the event fee is how much you imagine will be costing each participant. And this is something that can vary depending on what your goal is related to your bottom line. So for example, if I put actually it's $12 per participant and there's 40 participants, it will change that automatically for you. Also, you'll have an opportunity to write your grants. So here we have a United Way grant. Also donations. So this might be, this is what a foundation may have provided for you, but you're in kind, and we'll see how that calculates. You have to account here, if there's in-kind contributions in your expenses, you have to imagine that that's the contribution in your revenue source as well. And then of course we have other partners that might actually contribute finances, or they might actually contribute things like space or parking or any other financial dollars that you need to account for. So that's all the different ways, and you can add, of course, to this, but for your revenue, for you to be really thinking about where is the money coming from, and when it's donated stuff, I want to account for it as well. In terms of HR, there's different categories. A big one, and often where our dollars go, is HR. So again, you want to think about what's it going to cost to run this? And you might say, well, that's just part of someone's job. And that's good, except that sometimes it's actually helpful to understand what does it actually cost to run this program for us to calculate it. So here you'll see that it says paid staff. So how many FTEs, what's their hourly wage, and how many hours are they going to be working on it, and that calculates it. So let's say in your organization, it's more like $30, then it will change the cost of that. The volunteers, again, you want to capture them in kind. I just put living wage here for us. Students, again, you might want to capture that as in kind. And then peers, people with lived experience. And you say, I really do want to have peers. I want to pay them. Okay, how many am I going to have? How much am I going to pay, and how many hours do I imagine? So it's all there for you to calculate the HR piece, any training that's required. You have to also account for travel and parking, anything else miscellaneous. So you have your actual costs, your hard costs, and you also have your in-kind costs related. So you're able to clearly articulate what it costs from an HR perspective to run the program. You'll see here in the variables, we have 40 participants, and you might say, oh, I have to think about travel for them. If we have any swag like t-shirts, and you might have a budget for it, you might say, so it's $4. I don't know what you can get for $4, but let's pretend materials that a participant might need. You might say, okay, you know what, we're going to tie dye, so I need to think about that. Or I'm running a workshop and I have to have materials, let's say mental health workshop, and then food and beverages. So again, now you're able to articulate and say, well, if we have 40 participants, I'm going to have to budget for $610 to have all of these things. Related to fixed expenses, then here you'll be able to see, okay, what are things that doesn't matter how many people come, I still have to think about. So meeting space would be one, but again, if it's donated, you want to put that in kind, so you capture it, but also your supplies that are not per participant that are related, training, any advertising, although social media is so big that we don't have a cost for that. Equipment there, so you'll see all of the different things I need to think about, furniture, computers, admin costs that I might want to think about. So we're trying to provide you with a template with all the variety of things that you need to be thinking about, so that we can keep the expense in check with what it really costs to run a program. And so you'll see that right now, the way that I have it is that it's a net of a loss of $520. So we really want to think about, okay, what do I have to do? Do I have to raise more dollars? Is it okay? Is my manager okay with the fact that we're going to run in the red? Or do I have to increase what it would cost per person to come? So these are up, you can get sponsors, all of those things, but you at least know what it is that you're aiming for. So here, as a part of this template, we also provided a place that tells you what the cost per participant is, which is a really helpful ratio for us to have. Again, if you're thinking, I want to know what it costs to do it in person, and I want to know what it costs virtual, you can do a comparison and then get it down to a cost per person so that you have an idea of the difference. That's a really good ratio or information to have. And we also have a return on investment, which of course is current investment, so revenue minus current expenses divided by current expenses. And if you want it as a percentage, you multiply it by 100. This number is helpful in terms of return on investment so that you can capture all of it and be able to compare one against the other to see which one is a better return on investment overall. So we hope that this template is able to provide you with a way to detail a budget so that you can speak with confidence about what is needed to run the program from a revenue perspective and also from an expenses perspective. So I think this slide just gives us those definitions that I just talked a little bit about in terms of cost per participant and then return on investment. And with that, I'm going to turn it over to Carrie.
Thanks very much, Maria. That's a really valuable tool. You can use it for a one-time project that you're planning on doing. You can also use it to look at a program expansion or a new program, ongoing program to really spell things out. And I think it's really important that you do that work and not make assumptions ahead of time. I've been involved in situations where we've been comparing two options and didn't actually sort of at the first run through, didn't lay it out in that very, very detailed way, but sort of right out of the gate, you know, one thing was more expensive for a particular item on the line item. So that's probably not going to fly. And then no, let's sit down and look at the whole analysis, the entire financial, because in fact, that more expensive one was preferred. And when we looked at the entire financial analysis, we were able to say, you know what, it's not as much more expensive at the end of the day as the less preferred option, and it's worth that investment. So it can be really important to go through that detail. So just a few more slides here to look at finance and operations. So again, as your managers, leaders, or team members, day to day, engaging in your operations and making decisions, some things that are important to think about as you move forward in that. So we'll look at the next slide. Here's just a little bit more language to make sure that there's a comfort level with the language. There's 3 different ways to look at your budget and how you're creating a budget in the first place. The first word is planning. So often we will say budget planning or financial planning, but in fact, it's really important to look at your planning as your activity plan. Going back to your strategic plan for your organization, what are we trying to accomplish together in the next 3 to 5 years? If you're in a department, looking at then and saying, okay, how are we going to plan our activity this year to make sure that it aligns with our strategic goals and moves us forward in our strategic goals. So doing that activity plan first is critical. And then budgeting. So your budgeting then looks at, okay, if this is our activity plan, what is our expectations related to revenues and expenses for these activities? And then you can, again, look at, okay, does this reach a balanced budget? Does it have the expenses we were expecting? In some cases, if you're doing an operational budget for a department, you may not even have the revenue side, you only have the expense side, but you're asked to meet a particular target. So can we do these activities within the funding that we have available for this? And forecasting is another term that we use. And quite often, unless you're building a new program or a new project from scratch, when you're doing your budgeting, you're also looking at historical data. So how much did it cost us to do this exact same activity last year? Can we then assume it will cost us the same this year, or do we need to adjust that because we've had salary increases, because the cost of supplies have gone up? So forecasting uses your historical data to predict your outcomes moving forward. So again, 3 important steps to doing the work in the operations, and 3 different words, sort of lingo, language to think about as you're doing those steps. So if we move to our next slide, and we are looking at managing a department budget, again, it's really important to know, say you're a new leader, have walked into a new leadership or management role and said, okay, here's the budget that you have to manage in this role. Your first question really is, well, what is the plan behind the budget? What activity are we expected to be doing with this budget? Because if you come to a place where you're overspending in an area from what was budgeted or underspending in an area, you need to know, well, is the activity higher or lower than what we expected it to be? Because that's going to be a very good reason, potentially, that you are over or under budget, or is it something else? Are we spending more than we expected on a particular item because the price has gone up? So what is the plan that was used to create that budget? And how was it created? So again, did it just use a forecast? Did we just take last year's budget and apply it again this year? Did we take a percentage addition or reduction? So that happens sometimes in organizations where the message across the organization is, okay, every department, we've had a revenue cut, therefore every department needs to reduce by a certain percentage. Or we have new revenue and it's not program specific, therefore every department has a percent to increase. Or a particular department may have been given an increase or a reduction depending on activity or depending on funding. So was it created in that way, or was it a brand new budget that was created from scratch, where you used a tool like Maria just shared to lay out each individual item, understand it, to come to the bottom line of what it was going to cost? And in many organizations, year over year, you will find that some years they've used one strategy, some years they've used a different strategy. So it's important to know the budget that you're expected to manage, sort of how is it created, as well as what the plan is and what are the rules. So if you have a budget that you are managing, what is your authority over that budget? Are you allowed to go over in one expense line as long as your total expenses are on or under budget? Or are you expected that if any of your lines are going to be over or under, perhaps by a certain percentage, that should be escalated and you should share that with the person that you report to and have conversations about that? So making sure you understand the flexibility that you have and the rules that you need to follow related to managing your budget. And again, those financial monthly reports should come to you. If you're managing a budget, you should be getting an income statement or a statement of operations for that budget you're supposed to be managing monthly. And it can seem fast from one month to the next. You just got one and it feels like the next one shows up, but it is important to set aside the time to review those so that you can compare what have we been doing compared to what we budgeted, what's happened this year compared to last year. And again, what was our plan? and what's actually happened. Have our volumes gone up in a particular area or down? Has our complexity gone up or down in a particular area? Also looking at, does time of year make a difference? So depending on the program or service that you're budgeting for, sometimes there are seasonal changes to activity. So yes, it may look like we are under budget in our expenses. December is a great month to talk about. If your budget just, your monthly budget is just 1/12 of your entire budget. December budgets for many organizations or December actuals are lower than other months. And there may be organizations where December spend is higher than other months because it's a unique month with all of the holidays and things in it. So understanding how time of year impacts your budget is important. And remembering as you're doing planning programs, planning projects, planning budgets, that unintended consequences will happen. Looking at the visual we have here, any one of these elements changing will change the entire trajectory of what's supposed to be happening. So you need to think about that as different elements changed, how have they impacted our finances? So unintended consequences is something that I really like to make sure we think about. If we're going to reduce our budget on this particular line, are we just passing costs on to somebody else? By doing that, it's making our budget balance, but the next department over ends up with extra expenses they weren't counting on. If we make a change and sort of ask staff or clients to do things differently because it's going to have the same outcome, the same positive outcome for clients, but it's a more efficient, financially effective or efficient way to do it. But will people actually behave the way we expect them to? If we ask clients to register online instead of calling, and then we don't have as much time on the phone, will people actually be able to make that change? Do they have access to the internet, for example? Again, think about if we do one thing, how does it impact something else? How do we change other things when we make our decisions? And short-term versus long-term thinking. So boy, we could cut this now and save money this year, but it's going to cost us money in the future because we've shortchanged ourselves. Or is it important to spend more money than we anticipate this year because it's going to save money into the future? So again, that's where your return on investment can be helpful. There's a link there to an article on unintended consequences that gives you a little bit more depth in understanding behavior change and potential unintended consequences. And our last slide as we move into close up, there's just some rules of thumb here as you're doing a budget. And a really good idea to check with your accounting department because your organization may also have rules of thumbs. When you think about, for example, if you're adding a program that has one full-time person 8 hours a day, that's 1 FTE. If you're adding a 24/7 service, it's actually 4.2 FTEs for each person you need because of the amount of time that you're covering. Some other things to think about that will go up relative to people or volume, fixed costs, making sure you've calculated in that you need a computer for a new person, for example. And again, as per the previous slide, thinking about, is there anything that you're doing that's actually going to add costs to other departments? Creating a new program may have effects on other departments that you want to think about. So I'll quickly hand it back to Maria for the last minute to wrap up. Thanks.
Thank you. Yes, there's so much that could be said about finances. For the reflection questions, we want you to review the annual financial statements from your organization or an organization in your sector that publicly posts their financial statements. Typically, you can find them in their annual reports or on their website. What do you see in those financial statements that helps you to understand the organization better? Start to think critically about the information in those financial statements. What is a project, for question number 2, or a change that you would like to see your organization take on? Using the project financial tool, complete a financial analysis of the project. Use estimates and rules of thumb for numbers if you need to. It is more about practicing with the tool than coming up with the perfect bottom line, unless you're actually planning on proposing the budget, in which case the more accurate, the better. But have fun with it and just learn to use the tools that are available to you. And again, it's about practicing, practicing, practicing. And so we want to say thank you. Thank you for being here. And we look forward to sharing our last session with you, strategic thinking applied to day-to-day work and decision-making. See you then.